Hello and welcome to Upstack America's Oracle EBS Financials Functional Training. My name is Bob and I'm the lead senior consultant for Upstack America. And with me today I have Victor, who is also a senior consultant. Today we are handling General Ledger Lesson 20. And Victor, please walk us through.
Thank you, Bob, for the introduction, and welcome to the 20th lesson in this Oracle Financials Functional Training. Today we are going to continue with our concepts on foreign currency, and particularly we are going to cover the topic of revaluation. Okay, so to start off, let's discuss what revaluation is. First of all, revaluation is we are required to do evaluation when there is exchange rate fluctuation against receivables or payables accounts. So revaluation is usually done at the end of a period before running our financial reports. As we said, the periodic cycle of general ledger, where at the end of the period we usually generate reports. So we do revaluation before we run those reports, and the reason why we do this is to avoid understating or overstating our accounts before we do our reports. And when we run revaluation, it usually produces a journal, and this journal usually hits a balance sheet account, or sometimes it can hit an income statement account together with an exchange rate gains or loss account. Well, this can be one account, the gain and loss, where we debit or credit, or you can have an account for exchange rate gain and a separate account for exchange rate loss. And when I say account in this case, I mean like a natural account that we're going to add to our value set. The other thing maybe that we need to know about revaluation and the journals that are produced by the process is that these journals are usually reversed at the open of the next period. And as we delve into this topic, we are going to see why we do this. So in order to get an idea of this concept of revaluation, we are going to go through a couple of examples. And we are going to start with one that affects payables. And then we are going to look at another one that affects receivables. And hopefully by the time we are finished with these examples, we are going to have better clarity of what this topic entails. So let's assume that our company one, which is Maskani Developers, has purchased materials from Kenya for the amount shown here, which is 1,050 Kenya shillings. Okay. So in our previous lesson, we showed how when we have a business event like this, we can capture this information in a foreign currency journal. And we said in order to do this, we enter the amounts in the foreign currency. Then we provide an exchange rate, and these amounts are converted into the functional currency, which in our case is the United States dollar, and the balances are updated. So this page over here shows that particular scenario. So Maskani Developers purchased materials from Kenya for 1,050 Kenya shillings. On that day, which is the 5th of February 2018, that the date we are using in this example, the exchange rate was $1 was changing for 100 Kenya shillings. So when we entered this journal and we entered 1,050 Kenya shillings, when this amount was subjected to the exchange rate, then the accounted amounts ended up as this, right? $10.50 or $10.50. So since we are purchasing we debit our expense account and we credit our payables account. All right. So the amounts here I am showing are in dollars, but remember when we are entering the journal, as we saw in our previous lesson, we have columns for the entered currency and the functional currency. But here we're just showing the functional currency. So this is the journal that was entered and posted. A credit of $10.50 to the payables and a debit of $10.50 to our expense account. Okay. So now this journal was entered on the 5th of February. And since, as we see, it hit our payables accounts, it means we owe this company in Kenya, whichever, or Maskani. Maskani owes this company in Kenya that it's doing business with this amount, okay? So now it comes to the end of the period, right? The 28th of February, okay? Remember, we are still indebted to, Maskani is still indebted to this company. We have still not yet cleared our account. We have not paid our liabilities to this company in Kenya. So we still owe them this amount in Kenya shillings, or 10.5. We still owe them this amount in Kenya shillings, all right? However, at the end of the period, because exchange rates usually change, this is the effective exchange rate on this day, on the last day of the period. So the dollar, $1 is now changing for 105 Kenya shillings. In the previous example, on the 5th of February, it was changing for 100 Kenya shillings. So in real sense, on the 28th of February, Maskani now owes the company in Kenya $10, not $10.50. Okay, because this amount in Kenya shillings, which that company is claiming, the one in Kenya, has not yet changed, but the exchange rate has changed. So in US dollars, Maskani now owes $10. But remember, this is the journal that we entered, that is showing $10.50. Now, the 28th of February is the end of this period, and we need to run financial reports at the end of the period. However, when we when we run the reports in this state, we are going to be overstating our liabilities to the Maskani is going to be overstating the liabilities to the company in Kenya. Okay, because the exchange rate has changed. So before, Maskani owed $10.50, but now they owe $10 because of the change in the exchange rate. So this is where revaluation comes from, and you can tell now that even from the name, you can tell the meaning. We are Maskani is going to have to revalue their liabilities to the company in Kenya to reflect the actual amount in view of the new exchange rate. So this is where we now run the revaluation process. So what happens when we do the revaluation process? When we do the revaluation process, a journal is going to be produced, okay? And that journal is going to debit the payables account, okay? Because what has happened is our liabilities have reduced. The dollar has strengthened against the Kenya shilling. So now fewer dollars can pay for the same amount of Kenya shillings. So the journal is going to debit the payables account by $50, and then it's going to credit the loss gain account by $50. All right. So when we do that, what happens? Now I just changed these amounts to reflect the change, but remember this journal had already been entered. So in real sense, the journal remains this one with 10.5. Okay. But once we debit this $50, which we have gained because of the exchange rate fluctuation, we will now owe $10. All right, so it was 10.5 minus this 0.5, which gives 10, and the loss gain account will be credited by that $50. So the end result will reflect the actual liabilities that Maskani owes to that company in Kenya. All right. The loss gain account, we can give it an account type, the revenue. Remember, we have the types of natural accounts: the revenue, expenses, assets, and so on. So this account, we'll give it the account type revenue. So we are going to credit the payables account. We are going to debit the payables account by $50, and then we are going to credit the loss gain account by $50, which will reduce which will increase our revenue, because this is a revenue type of account. Okay, so at the end of the year, when we are closing these accounts, this will be closed together with the other revenue accounts. All right, so that is how revaluation works on the payables side when exchange rates fluctuate. And this can also happen in the other direction, meaning that in this case, the dollar strengthened against the Kenya shilling. We will also follow the same process if the shilling strengthens against the dollar. All right. So if the shilling strengthens against the dollar, it means that our liabilities will go up, not down. All right. We are going to take a small break, and then we will resume. Okay, so that is how revaluation on the payables side works. So now let's look at the other side, which is receivables. So in this example, Maskani sold a company or a client in Kenya some materials, and those materials were worth the same amount, 1,050 Kenya shillings. Okay. So this foreign currency journal was entered with and the effective exchange rate on the 5th of February was $1 changing for 100 Kenya shillings. So when you convert this Kenya shillings to US dollars, you get $10.5. In this case, Maskani is owed $10.5 and generate credit side revenue of the same amount. Okay. So come 28th February, Maskani has to run financial reports at the end of the period. However, this transaction is still open because Maskani has still not been paid by the client or the customer to whom they sold these materials for. However, on the 28th of February, when they are running their financial reports at period end, the exchange rate is $1 for every 105 Kenya shillings. So in light of this exchange rate, Maskani is now owed less by this company, right? Because the dollar has strengthened against the Kenya shilling. So now 1,050 Kenya shillings is worth $10. But remember, on 5th February, we entered the amount as $10.50, okay? So what happens? Before they run their financial reports, Maskani will carry out the revaluation process, okay, to revalue the assets, because receivables are assets, to revalue the assets which they are owed by the customer in Kenya. So when you do the revaluation, this is the journal that will be produced, this journal B, and it will show that we have credited $50 from the receivables account, and we have debited, all right, we have debited $50 from the revenue account. So the value of that asset has gone down because the dollar has strengthened against the Kenya shilling, all right? So as you have seen, revaluation works the same way both ways. The difference is just the accounts that are hit, but the idea is the same both for payables and for receivables, all right? So revaluation usually affects YTD balances for the balance sheet accounts, which are the examples of the balances that we have been using here, payables and receivables. These are balance sheet accounts because they are liabilities and assets. However, a client may have the need to do revaluation against income statement accounts. And for instance, for income statement accounts, they can choose to revalue either year-to-date balances or period-to-date balances. So if they want to choose, this is the profile option that you use in order to be able to choose whether you want to use year-to-date balances or period-to-date balances in the case of income statement accounts. However, for balance statement accounts, you run a revaluation against YTD balances. So we're just going to take a look. Let me log in. We're going to take a look at the window for revaluation. So the navigation is going to be currency then revaluation. So this is the window where we do the revaluation. Before we do a revaluation, remember we have to create the gain and loss accounts. In our case, we are going to use one account, and then we have to select the accounts here where we want to do the accounts that we want to do a revaluation for. So in our case, it's going to be we're going to do an example for receivables, and we are going to do another example for payables, right? So, however, since this is going to take, I want to do the demonstration in one setting. Let's get comfortable with the concept of revaluation, which we have understood how to do. And so, Bob, unless you have something to add, we are going to end this lesson here for now.
All right, I think we are good. Thank you so much, Victor.
Thank you.